Hey everyone, it is Julie here with TipRanks, and today we're taking a look at 3 strong buy stocks that have recently dipped in price. So let's get into it. Alright guys, welcome back. Thank you all so much for being here. Today we're taking a look at 3 stocks that have had some red days recently, one of them dropping quite a bit today. But all 3 of these companies do come in with unanimous buy ratings from Wall Street. So we're going to take a look at these companies, what it is that they do, what has the stock falling lately, and what those Wall Street analysts are predicting for the future. Just before we get into that, this is your friendly reminder that if you enjoyed today's video, make sure you hit that thumbs up button and that you're subscribed to the channel as well. Now let's take a look at these 3 unanimous strong buy stocks. First on the list today is a company called PROS Holdings. They trade under the ticker PRO, currently priced at $30.75 per share. Now, overall in the past year, they are up over 19%, but in the last 3 months have fallen 15%. And you can see just a couple of days ago, the stock took another drop here, down 6.5%. PROS Holdings is a software company in the cloud computing world. They offer products featuring price optimization, revenue management, and sales effectiveness powered by AI and designed to streamline retail transactions for both merchants and customers. PROS clients include companies in the airline, automotive, consumer goods, energy, manufacturing, and logistics industries. PROS did share their Q1 earnings report earlier this week, and as you saw on the chart, the stock did dip afterwards, and this was despite an earnings and revenue beat. For their Q1, they did report earnings per share of 4 cents, beating estimates by 3 cents per share, and revenue of $64.3 million, which grew 15% year over year. The company also launched their PROS Copilot for Sales plugin in collaboration with Microsoft, making a significant milestone as the first integration into Microsoft's Copilot for Sales. Following that earnings report, we have had 3 analysts reiterate their buy ratings on the stock. Altogether, it comes in as a strong buy with 7 unanimous buy ratings. And the average price target comes in at $41.17 for an upside potential of 33% from current prices. Looking at the list down below, we have several analysts all weighing in with the same price target at $40 with upside of 28.4%. That is actually our low-end price target, with the high end coming in at 44% upside. Second on our list is a company that's taken a big hit just today following their latest earnings report. That is SkyWater Technologies. They trade under the ticker SKYT, currently priced just shy of $7 per share. Now, they were trying to climb up here over the last 6 months, gaining 18%, but today have fallen over 30% after their quarterly report. SkyWater is the only U.S. investor-owned pure-play semiconductor and technology foundry. They pioneered the TaaS model, or Technology as a Service, to design, develop, engineer, and manufacture semiconductor chips operating through the full process, from the computer models to the foundry floor. They partner with fabless companies in a wide range of applications from aerospace and defense, automotive, consumer, healthcare, and industrial. They reported their Q1 earnings earlier today, and as you saw, the stock has been plummeting since. Now, they did report record revenue, but both revenue and earnings did fall short of expectations. For their Q1, they reported a loss per share of 8 cents, which was 3 cents wider than anticipated, and revenue of $79.6 million missed estimates by about $400,000, though it did grow about 20% year over year. They said that their Q1 tool revenue came in lower than forecasted due to delays in equipment deliveries, but that they continue to anticipate another year of revenue growth for SkyWater in 2024. Following today's earnings report, we've already had 3 Wall Street analysts reiterate their buy ratings, one of those coming from Craig Hallam. They maintained their buy rating on the stock, noting that in the 2 years since its initiation, SkyWater has achieved its goals for the most part, with strong upside to sales. However, mixed issues and increased OPEX spending materially hurt the near-time profitability profile that was a strong selling point for investors, and a large charge from the Rad-Hard program does raise some questions. But following that 30% dip today, analysts certainly see the room for some upside. The stock comes in as a strong buy with 4 unanimous ratings. And the average price target comes in at $15 per share, which would be an impressive upside potential of about 119%. Down below, you can see those 3 ratings all reiterated today, a couple from some 5-star analysts as well. Our high-end price target is 117% upside from TD Cowen, and the low end is these 2, just shy of 74%. If you've made it to our third stock today, this is your reminder to make sure you hit that thumbs up button. Third on the list, we're taking a look at Digi International. Their stock trades under the ticker DGII, currently priced just above $27 per share. Overall, in the past year, the stock is down over 13%. It was trying to climb back in the last 6 years, gaining 21%, but you can see here at the end of April, the stock has fallen and is down 10.5%. Digi International is known for its innovations in the world of IoT networking. They focus on the network technology that makes IoT possible. They point out that 23 billion IoT devices will transmit over 430 trillion bytes of data in a matter of seconds. They offer a wide range of products to make this technological miracle happen, including embedded and external wire and wireless network communication support hardware. The stock did fall following their Q2 earnings report, despite posting both an earnings and revenue beat. Revenue did decline slightly year over year, and their forecast for Q3 sales was below expectations. Revenue came in at $108 million, which did beat estimates, but fell about 3% year over year, and the company had earnings per share of 49 cents, beating estimates by 2 cents. They also saw record end-of-quarter annual recurring revenue of $110 million. But they do see their fiscal 2024 revenue being down 5%, saying that the macroeconomic conditions have them uncertain as to when and to what degree sales cycles will return to more normal conditions. Following this Q2 earnings report, we did have a 5-star analyst from Piper Sandler weigh in on the stock. They noted that the company reported solid results for the March quarter, but did guide slightly below expectations for the next. Digi is primarily seeing tight wallets in IT spending for its offering, which is lengthening deal cycles. The Digi stock does just have 3 current analyst ratings, but all do come in with a unanimous buy, with an average price target of $37.50 for an upside potential of over 38%. Looking at those most recent ratings down below, all coming from 5-star analysts ranging from an upside of 29% to 47%. So that is a quick look at 3 stocks that have recently seen some red, but still have unanimous buy ratings from Wall Street. Let me know your thoughts on these 3 companies, and if any of them catch your eye, I always love hearing from you guys. Of course, keep in mind these videos are never a suggestion to buy or sell any specific stock, so please make sure you stick to your own investment plan and do your own research and due diligence. Thank you guys so much for watching. I hope you have a great day, and I'll see you back here next time.